Good morning. It's Friday, October 3rd. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So congratulations to the Chicago Cubs advancing in the playoffs. Now, the U.S. government shutdown, day 3, does continue, and U.S. equities continue to make new all-time highs. It's been 114 trading sessions since the S&P 500 has had a 5% pullback. You look at overnight here, the S&P 500, the NASDAQ up about 0.3%, on course for the longest winning streak since July. Friday's jobs report is set to become the latest casualty of the U.S. government shutdown, and that should keep some of this volatility subdued. So you look at the volatility index edging just a bit lower. You got gold futures advancing this morning and on track to post a 7th consecutive weekly gain, really supported by the expectations of further U.S. interest rate cuts, a declining dollar. There are some concerns about the U.S. government shutdown, but much of that sell-off here occurred at 12:01 as you got into that markup here for month-end, quarter-end. Futures contracts shot up aggressively. The U.S. government shutdown becomes a reality. You see the sell-off in U.S. equity markets here from a global perspective here because it happened overnight. And then what occurred? The dip buyers came in here focused on 100% of all government shutdowns have resulted in what? The government ultimately reopening. So you check on your setup here, you look at some of these outside markets, you have copper futures rebounding here, continuing to break higher here, taking out a previous resistance zone that we had seen. If you go back on the charts and you look prior to that ramp up that we saw in July, you'll see that this was a resistance area around a psychological $5 zone here, but you really shouldn't use these round numbers here because markets sometimes they just don't reach them, and sometimes they just overshoot them. So you look at things like $4,000 on gold. The reality is that the possibility for an overshoot above that key level here becomes a reality. You look at silver futures, $50. What if we never get there? The point is here is that it's very dangerous to have these round numbers stuck into your head because of the fact that you might say, hey, I'm waiting for my account to hit X level. I'm waiting for a particular commodity to hit X zone, and it just doesn't get there. And as long as you're not paying attention to, or you're only paying attention to one specific number and not all the different things that are surrounding it, key developments, key dynamics may change in that particular market here. What if silver approaches this $50 and then all of a sudden companies start shifting the amount of silver that they're using, or they start looking at alternatives, or ETF outflows occur and things like that? You're gonna wanna pay attention to all the different variables out there. So get these round numbers, get these. One of the things that I always cringe at, and I do a lot of television, a lot of different media outlets, and one of the things they'll ask me for is what my outlook is. And the reality is that I take it on a day-by-day, week-by-week basis, and really the farthest out that I look is what are the possibilities that are going to drive this thing into a quarter. So you do get that year-end as this quarter, but I take it quarter by quarter because that's the way that the cycle works in many of these different commodities. Remember, when you look at something like soybeans, something like the agricultural products, you've got a planting season that goes on. You've got where the crop matures, you've got your harvest, you've got your demand, and that's where you look and you see where prices can go within these different elements, because the elements in the commodities markets, they oftentimes change. You look at copper, for instance. Copper didn't look like it was going to push on back up, start to challenge these all-time highs, and then what happens? The dynamics change where you get Freeport-McMoRan coming off line here with one of their key mines. You also get some tariff discussions going on. You've got increased demand and things like that. That's where you used to have to be able to identify, adapt, and rotate with the market here as far as when you have these price objectives in mind. Now you start to look at some other things, the checklist on the health of the market, which is oftentimes what I look at here and I start my day with. The dollar index here just ever so slightly lower, volatility index lower here, and then also 10-year treasury yields. They are pushing lower as well. So your current economic environment with U.S. equities pushing up, oil futures threatening to break below $60, it's really this bounce between some variables of stagflation and other variables of reflation. You look at the U.S. equity markets, you've got no significant earnings expected before the market opens. So you get to the economy. Well, the government shutdown, is expected to impact the scheduled releases, including the September non-farm payroll, the unemployment rate, yes, the PMI final readings here, and the ISM services here for September. So sad day for myself and the data dogs here because we just won't get that. Now, taking a look at the global markets, and it's very important to pay attention to the global markets because it's not just the frothiness that people will call the bubble and things like that that are occurring in the US and the US equity markets. You want to be able to look at all these different economies, these global economies, and how trading partners interact with each other. Because oftentimes, if you start to see one country really fall apart, you'll see their trading partners or other countries that are within close proximity really fall apart. I remember in 2008, we were focused on what some of the media like to call the pigs. It was Portugal, it was Spain, it was France, it was all these other countries here that were just really in this high debt bubbles, and that was when they started to fall. That was when the cracks were really forming. So I'll pay attention to what are these key trading partners with the United States, what are these key export countries, who's being hit by the hardest tariffs, and then how are their economies performing. Well, you look at European stocks that are on track for the strongest week since May, gaining for the 6th straight day in a row. You look at Asian stocks, well, they're rising here for the 5th straight trading session. The MSCI index rising 0.5%, really closing out that week. Big move higher, up about 2.5%. So you look at what Asia's, some of their trading partners are at, and you look at the Australian stock market, well, that's the ASX 200. That's ramping up here, looking to press on through all-time highs here, yearly highs, and up about 9.5% this year. So we'll look at some of these other outside economies, and if they start to fall, then you, again, look at their different trading partners. Argentina, for instance, that's one of the countries here that the stock indices are starting to crash, and we are seeing different elements of Europe as well, where they are starting to kind of round out at the top a bit here, not cycling and making these lower highs on the charts, but just to be aware of what's going on in these different markets. So what you want to think about here as far as future interest rate cuts, the government shutdown, it looks like this is going to be much more prolonged. It's going to extend out at least 10 to 15 days or later, with the poly markets calling that about an 82% chance that this thing goes out about 10 to 15 days. You look at the CME's Fed Watch tool, well, that 50 basis point interest rate cut, it really came off the board yesterday. Now we've got it pretty much locked in here with a 25 basis point interest rate cut at the October 29th, 28th meeting here. Then you go into the poly market, you got a 90% chance here of a 25 basis point interest rate cut. You look at the precious metals, those ETF flows. So there was a little bit of panic selling, but when you look at the numbers as a whole, the exchange traded funds, they only added about 3,800 troy ounces of gold. So it looks like the number of people that were cashing in and selling and the number of people of buying that dip here really had kind of balanced out each other, because futures prices, when it was all said and done, really didn't go much of anywhere here. You look at the gold market, excuse me, the ETF flows 17% here year to date, 6th straight day of growth here, longest winning streak since September 2nd. And then you go to the total gold ETFs, they are at 97.2 million ounces, the highest level since September 28, 2022, and gold, of course, up about 47% this year. You go to silver, up 16%, and the ETFs, they cut about 1 million ounces of silver here yesterday, and I can see what they were doing was, you look at the average true range on silver, it's about $1.10 here. What was the sell-off yesterday? It was about $2. A lot of people had cashed in. We're going to wait for the dust to settle here rather than re-enter aggressively and right away. So what they were looking to see is if this was a 2-day event, perhaps they were able to get those prices dipped down to about $44, $45 here. And what happened was you saw the snapback and some of the dip buyers come into the market. It's a lot of the people that are either late to the game or they are underinvested in the silver market. They trim profits off too early. Those are the people that are most likely going to pull the trigger right away. And that's what we saw here. And that's what I tend to see here across dealing with hundreds of clients and how they position and what their psychology is with a lot of those dip buyers taking place here, or their first time enters into the silver market in anticipation for something like that round number, like that $50 mark here to come into play. So you look at the other metals here, they are again rallying up and you're getting some broadening taking place. You got a lot of red on the screen in the agricultural products, really corn, soybeans looking quite weak here despite that little bit of a snapback that we saw in the soybean market, fueled by optimism that the administration is going to do government handouts to the farmer. You look at cryptocurrencies, are taking just a bit of a breather after challenging what looks like to be all-time highs on the Bitcoin. So I'm going to have to look at that a little bit more here. A lot of traders here trading a lot of those cryptocurrencies on the futures markets as that product really takes off, takes steam. Remember, we could trade Bitcoin, Ether, XRP, and also Solana. A lot of people liking the leverage on the XRP contract. And remember that futures and option trading, using this leverage here, it does involve risk of loss, and it may not be suitable to all investors. So good luck, good trading. Have a great weekend.